everybody. I want to talk to you today about some investment advice that myself and probably most financial advisors have given to clients over the last 10 years that has really not worked out that great. Fortunately for most of you, you didn't listen, so you didn't have to experience the downside to this guidance that financial advisors across the country have been giving out for the last 10 years. So what am I talking about? I am talking about allocating a percentage of your portfolio into international equities, or in other, in kind of straightforward language, investing part of your money in international stocks, or buying shares of stocks of companies that are not based in the United States. So I get to look at hundreds, maybe thousands of people's investment portfolios when I'm meeting with them before they retire, and to give recommendations about how they might position themselves to have a successful retirement. And as part of that process, lots of observations that I make, and one of them is that your typical person in that position has little to nothing invested in international stocks. Sometimes, you have a kind of a token percentage of 1, 2, 3, 4, 5, something less than 10% of kind of an overall stock portfolio invested in international equities. And the typical guidance and advice that, people who give investment advice to clients for a living, and the thing that all of us learned in school and in, with investment firms is that, some certain percentage of a portfolio should be invested in international equities. And there's lots of reasons for that. There's historical, analysis, looking historically at what other stock markets have done compared to the United States. And you could say, hey, international markets at times in the past have done better than the United States. So it is reasonable to conclude, or a high chance to believe, that in the future there might be times when international markets do better than the U.S. stock market, the good old faithful S&P 500. For the last, basically since, let's call it the financial crisis, and more specifically maybe like 2011, it just has not been the case. Stock markets around the world went down with the financial crisis, and then as they popped out of that in 2009, the U.S. market has far and away done better than international markets. So this video won't be too much about the reasons and all that sort of thing, but maybe I just want to have a, I don't know what this is, maybe a mea culpa here, talking about one of the conundrums that financial advisors have as they give investment advice to people. And well, maybe I do want to talk about some of the reasons for those recommendations. So let's look at some information, and maybe I can convince myself through this information I'm going to share with you, maybe I'll convince myself that it's still a good idea to recommend that people who are about to retire still invest a portion of their portfolio in international stocks. Or maybe I won't be able to convince myself or you. Not sure. Well, let's look at some information here. Hopefully this can be fun and educational, and we can learn some things about investment principles as we get closer to and in retirement. All right, so this is the chart that I was talking about, and what we're looking at on the screen here, the purple line shows international stock markets going back to 1996. The gray line shows the U.S. stock market, the S&P 500, and we can follow these through time, and you can see that, I'll get my little arrow out here, you can see that, we're kind of, going along. You can see these are kind of very tightly correlated together, right? They kind of go up together, they kind of go down together, and this, just as sure as the sun rises, you can see here in the financial crisis, they both go down together, and then they both pop up. But then right about here, 2011, there is this big issue, and that is that the U.S. market did this while the international markets have done this. And this big gap between these two is the return that people have missed out on if they were great clients who listened to every piece of guidance that they received to diversify their portfolios and have a significant amount of their money invested in international equities. Well, what's interesting is that even though this has been the case for, let's just use 15 years as a shorthand, for the last 15 years, they've significantly underperformed. Investment managers from the biggest investment companies here in the United States, as well as investment and financial advisors, are still giving the recommendation for their clients to take a portion of their money, invest in international stocks. Let's take a look at the different types of investment guidance that are being given out right now by the biggest investment houses about how somebody, if they're looking for what's called a growth portfolio, kind of has a long-term approach, that sort of thing. Let's look at the recommendations they're making. All right, so the first investment manager that we're going to look at is good old faithful Vanguard. So looking at Vanguard, this is their strategic ETF model portfolio series. So depending on kind of like what your goal is or whatever, if you're, this money is going to be invested for something short term or, long term or whatever, this is kind of their framework of investment asset allocation, kind of what percentage of your money you invest in different investment categories. So let's take a look at what they are currently recommending in their investment models. And if anyone from Vanguard's watching this and takes me seriously, please don't. This is just for educational purposes, and I've got all the respect in the world for all of the investment managers that we're going to discuss today. So let's look at some of this general stuff. So I want to look at portfolios that are kind of growth oriented to be invested in 100% stocks. So over here on the far right hand side, you can see we have the general allocation that they recommend. So here we have domestic equities. That'd be like, let's just call it the S&P 500. Here we have international equities, international stocks, and then since we're looking at then we have bonds, international bonds, money market, that sort of thing. Well, since we're looking at just 100% stock portfolios, we just have to look at these two numbers here, and you can see that within this portfolio model series that the basic recommendation is about 60-40, 60% of an all-stock portfolio to be invested in U.S. stocks, and the other 40% be invested in international equities. Okay, that's kind of a lot. So maybe what is that about? I'm curious about kind of philosophically, or kind of what is the why is that high percentage being recommended within this particular? They have other investment strategy things, but within this core kind of low-cost index approach, why is that the recommendation? So this is me just kind of speculating off the cuff here, but what I imagine is that obviously the people over at Vanguard are not, they're not ignorant to this information here of how much international markets have done relative to U.S. markets. They're definitely aware of this, obviously. But I think philosophically, this investment approach that is being presented here is based on a global market cap. So what they're trying to do is create a truly passive investment approach, not just U.S. based, but globally based. And if you had a passive approach, a passive global portfolio, you would have about, the U.S. makes up about 60% of global equities, and the remaining 40%, plus or minus, is our, other stock markets. And so if you're going to be a truly passive in kind of the purest sense that it's possible with stocks, this is how you would allocate it. And obviously there's tremendous benefits to doing that. You have lower costs, and we know that that's important with investing. You have less trading involved. That's good for taxes. And so over long periods of time, a portfolio like this that's invested kind of in a global passive portfolio is probably going to do quite well. In spite of the fact that, for the last 15 years, a portfolio like this would have significantly underperformed, somebody just, what your typical, investor has, which is most of their money invested in the S&P 500, right? Okay, so let's look at some other investment portfolios. So now I'm coming over here to BlackRock, and I went into their kind of advisor area and generated a target all equity ETF portfolio to see what they would recommend. And it's pretty close. I mean, there's some little differences here that we'll look at. You can see that for this 100% BlackRock equity ETF portfolio, in kind of the broad categories, you have 70% of it invested in U.S. stocks, and most of that here is an IVV. This is an S&P 500 ETF, very low cost, and about 22% invested in international/global equities, right? And you got a breakdown of, growth and value and developed markets, emerging markets, that sort of thing. And then they have it broken down a little bit more. You have 6% in kind of a slant. And I haven't looked at maybe the commentary on this current investment portfolio, why they're recommending this sort of thing. I'm guessing, based on their investment committee, they are they have a conviction that for the foreseeable future, or some period of time, it's going to be advantageous to have maybe some extra weighting to these sectors. We got infrastructure and technology. Okay, great. So overall, if we look at this like U.S. versus international, really we have here 70 plus the 6, so 76. Let's just call it 76 and 22. We'll go 75-25. So still a significant percentage of the portfolio invested in international stocks. There's some other things that I think are worth mentioning in this model portfolio that if you were an investor, you'd want to be aware of. So one of the issues that you face when you invest in international markets is it's not just about the performance of the stocks, the companies in another country. The other kind of element, I mean, let's just talk about it. Investing in companies, investing in their stocks, whether it's international, some other country, the U.S., you have the same drivers, the earnings of that company, the growth in their earnings over time, their profitability, their, all these sort of things that go into, how much a company is worth and how that stock price adjusts over time. Well, that all applies to international stocks as well. But there's another layer to consider when investing internationally, and that is currencies. So, for example, you might have a company in Germany or in France or in China or in Japan, wherever, and that company, let's say that they earn revenue in the currency of their country. So in Japan, they're earning revenue in yen, and so us as U.S.-based investors, if we own shares of that company, the profits or the revenues of that Japanese company have to then be converted into U.S. dollars, and so we recognize the benefits or the growth or the losses of that international company, taking into account the currency exposure. So sometimes, if over the course of a year, if the value of the dollar relative to, let's just keep it with Japan for a minute, if the value of the dollar is going up relative to the value of the yen, if there's kind of this thing happening over the course of the year, even if that Japanese company had just an awesome year and, as a Japanese investor, maybe you earned 50%, I don't know, whatever. As a U.S. investor, if the dollar is strengthening relative to the yen, then the returns that we're going to get are going to be lower. Okay, so that's worth considering. And in fact, this this currency issue is something that has in large part impacted international stock returns for U.S.-based investors over the last 15 years. It's been part of the equation. Well, on the flip side, it can go the other way as well, where if the dollar weakens relative to an international currency, take that same company and had 50% for a local Japanese investor. Well, if the yen goes up and the dollar depreciates relative to the yen, us as U.S.-based investors, we might have, we're not going to have a 50% return, we have a 60 or a 70% return, right? There'll be like a little bit of a boost because of that change in the value of the currency and converting it over from, the earnings of the company over into U.S. dollars. So that currency issue is something that you face as an international investor. The reason I'm talking about it right here is because in this BlackRock portfolio, you can see that with a couple of these funds, let's see here, mainly this ETF right here. Well, interesting. Out of the whole portfolio, as far as I can tell, there's only the one ETF that has a currency hedge, and so I'm not super familiar with this particular ETF, but kind of the big idea is within the investment approach, is there a way that they can hedge out that currency exposure so that us as U.S. investors, you can just experience the growth or the downside of those international stocks without the plus or minus of the currency. So interesting. All right, let's look at another investment house. We were looking at some information from J.P. Morgan, so let's see what their kind of their overall allocation is here. So we are looking at right here. We've got the J.P. Morgan Strategic 100-0 ETF model. This means 100% stocks, 0% bonds, right? Kind of an asset allocation model approach like what we've been seeing with the other asset managers. And pretty similar to, I would say, more similar to BlackRock, to iShares, than to Vanguard. So overall, the portfolio about 70% in U.S. equities, and then we have 26% in non-U.S. stock, international, a little bit of a cash allocation. I think that BlackRock's was, let's see here, I think theirs was 2, and that's pretty common when you look at these model portfolios. They'll always be, a couple percent allocated to cash. So anyway, and kind of a similar theme here. Even though obviously these investment houses are not, they're not ignorant. There's still recommendations about investing internationally. One of the other, one of the other justifications or principles that global diversification is based off of. So if you pick up an investment portfolio management textbook that you would see in any undergrad or graduate program, they're going to talk about the principle of diversification and something called correlation, which is essentially how does one category of investments, how does it move relative to another investment or investment category. So, if two investments kind of move in tandem, you would say they have a high correlation or a correlation of 1. Now, if you have two investments and they're just totally random, one's going up, one's going down, it's very hard to predict, you would say they have a low or even a negative correlation, right? And one of the principles of investment management is that when you combine different investment categories that have low correlations to each other, you give yourself the potential and the high potential to reduce volatility in the portfolio, and sometimes even the added benefit of maybe even increasing returns. So we'd say, your risk-adjusted returns are better if you diversify with low correlated assets. Well, that's kind of one of the investment kind of principles that investment management is based off of. Unfortunately, with international stocks, what we've seen is that the correlations have been low for periods of time, but the time when the correlation, when you want an investment to have low correlation, like when you want them to do something different, they don't. So what I'm trying to say here is that international U.S. stocks historically they've had varying degrees of moderate correlation, but when their correlation is very close, it's when everything's going down. So you're like, shoot. When the U.S. market is going down, I kind of hope that my international stocks would go up a little bit and kind of offset that. Hasn't really been the case. So maybe let's look at one other, let's take a longer view. We've been talking about investing in international stocks and that kind of being kind of a sucker's bet for the last 15 years. Let's take a longer perspective. So as someone who's about to retire, you're looking at, let's say you're in your 50s or 40s even, or even if you're in your 60s or even 70s for that matter, you might still be looking at 20, 30, 40, 50 years of an investment horizon, that you're going to have to depend in large part on your portfolio to grow over time and, provide you income and that sort of thing. So, looking at maybe just the last 15 years is not indicative, and it's not an appropriate time frame for us to look out at investing over the next, 30, 40, 50 years. So on this screen, this is kind of just maybe giving us a little bit of that longer term perspective. Going back to the early 1970s, we can see in purple here times when international stocks had relative outperformance to U.S. stocks. And you can see there's kind of a theme, back and forth. And for a lot of years, it's basically based on this data. That's what has informed, portfolio management, asset allocation decisions, for a long time, is this idea that, like, hey, don't have everything in U.S. stocks, because sometimes, there might be a 5.5-year period where international stocks significantly outperform U.S. stocks, right? And then kind of the baton gets passed back to U.S. markets, and then to international markets, and then back to U.S. markets, then to international markets. Well, okay, so here we've been for the last 15 years, and as you can see, we have just incredible outperformance of U.S. stocks relative to international stocks. 14.2 years, outperforming by 277%. It's just incredible. Interestingly enough, we had about a year and a half where international stocks outperformed U.S. markets for just a minute. And wouldn't you know, the baton flipped right back to U.S. stocks, back to outperformance. So if we look back over the last 15 years, it's hard to make a justification for investing any of your portfolio in international equities. However, taking a longer term vantage point or whatever, taking a longer term view, you can see that even though that's been the case recently, it has not always been the case. And I would venture to guess that it won't always be the case in the future. I would say it's probably more reasonable to expect that there will be times in the future when international stocks outperform U.S. markets. A purely passive investor, if that was kind of an investment approach or philosophy that you wanted to follow. Some applications that would say, who cares? Let's not try and figure out what's the right allocation of U.S. to international markets. Let's just use a globally weighted portfolio. And that's kind of the approach that Vanguard is taking in that particular investment model that we looked at. Let's not try and guess which is going to be better. Let's just kind of weight the portfolio based on what the global stock market is doing today. That's one approach. And I think over very long periods of time, it's a very good approach. And then we have the other two asset managers we looked at, BlackRock and at JP Morgan, where they didn't have quite that, quite as high of an allocation to international stocks as Vanguard did. And for the last 15 years, it's probably served them well. I intentionally didn't look at performance between these different models or whatever, because I just want to talk about principles here. But I'm guessing, I would expect that those BlackRock and JP Morgan models over the last 15 years, if that's how they were kind of put together over that period of time, they've probably done better than that Vanguard model. Does it mean they'll do better going forward? I don't know. Maybe not. Maybe one last thing about investing internationally. I mentioned the purely passive investor would say, okay, let's diversify globally based on the actual size and percentages of the global stock market. I would assert that there are reasons why somebody could prudently not follow that strict passive approach. And one principle is going back to currencies, like we talked about, a little bit earlier. That is that as an investor, I would have a preference towards investing in assets that are denominated in the currency that I have to buy stuff in, right? So if I live in the United States and when I go to Walmart or I buy something off of Amazon, I have to buy that stuff with dollars. Well, to protect myself from inflation or price spikes in my own country, it probably makes sense for me to have the majority of my personal investments denominated, in U.S. dollars, right? And that right there can be, maybe enough justification to overweight, U.S. stocks versus international stocks. And we looked at BlackRock, and the way that they kind of partially address that, at least in the model that we looked at, is by using investment vehicles that, that would seek to hedge out some of that currency risk. So with all this being said, maybe the takeaway here for the enterprising pre-retiree or retiree is that even though international stocks, okay, here it is. I just talked myself back into it, investing internationally. Even though they have not done that great over the last 15 years, I'm still, in my mind, it still makes sense to diversify internationally. And maybe it's not 50-50, but I would venture to guess that it's probably also not 95-5, 95% U.S. equities, 5% in international equities. Maybe it's a little bit more than that. Maybe it's more than 10. Maybe it's 15, 20, 25, 30. I'm not sure. But hopefully from this discussion, you have, kind of gotten some insights into the principles and the theory behind why these recommendations are made by financial professionals, and some understanding of the principles. Maybe that can help you, give you some insight into how you think it might make sense to apply these principles in your own situation. So, like I said, this is not investment advice, okay? This is just investment education. And I hope it's been helpful. Hope it's been a little bit entertaining. And until next time, wish you the best, and we'll talk to you soon.